In this second episode of a 6-part series on corporations, I'm going to introduce you to some accounting and finance principles. We will examine internal and external stakeholder concerns, cover a few accounting principles, and discuss some of the more important financial statements. If you enjoy this episode, don't forget to hit the like, subscribe, and bell buttons. Today we're going to examine how accounting and financial documents are used by corporations. There are two audiences for accounting and financial documents: internal and external stakeholders. This data is then used by the stakeholders for many purposes, including making business decisions, detecting fraud, investment, and compliance with government regulations. Internal stakeholders are those people that work for the business. The most common need for financial documents is to help in making decisions. For example, a corporation might own many different consumer products like toothpaste, potato chips, frozen hamburgers, outdoor furniture. The corporation could choose to operate all these product lines as separate divisions within one corporation, but that hides many of the costs associated with running each individual product line. So today, most corporations create subsidiary corporations and place each of these product lines into wholly owned corporations. This allows the parent corporation to better examine the performance of each of its product lines. So the toothpaste corporation will produce financial statements that better captures revenue and expenses. The parent corporation can then reward the managers of the most profitable corporations, fire the ones that are not performing well, or frankly, if they just want to sell a product line, makes it very easy to transfer that entire corporation to whoever wants to buy it. Internal stakeholders are also very interested in detecting fraud. A strong accounting system will not only capture revenue and expenses, but also have adequate controls to prevent stealing by employees. For example, without adequate controls, the head of the toothpaste subsidiary might steer lucrative purchasing contracts to a relative who then returns some of that money to the head of the toothpaste subsidiary. Now, this is the typical under-the-table transaction. One type of control to avoid this problem is to require an open bidding process where the lowest vendor wins the bid. Finally, internal stakeholders need good accounting systems and financial documents to comply with government regulations. One agency that we're all familiar with, I think, is the Internal Revenue Service, or the IRS. The IRS expects that businesses accurately report their revenue and expenses. For example, let's look at our toothpaste subsidiary. They decide to purchase $600 laptops for 100 of their employees. That equals $60,000. Under Internal Revenue Code rules, they can't just expense the $60,000 in the year that they purchased them. The IRS requires for certain assets, depreciable assets, that the toothpaste company claim the expenses for those computers over a 5-year period, and that's called depreciation. Now let's move to external stakeholders, right? These include owners of the business, shareholders, partners, depending on the business entity, potential owners, right? The people you want to buy your shares, government agencies, and employees of the business. In corporations, the owners are called shareholders. The shareholders use the financial documents in determining whether to keep owning the stock, sell the stock, purchase more. Some shareholders use this information to determine potential irregularities inside the corporation, which might lead them to sue the corporation. Investors also look at the financial documents and helping them determine if they want to purchase the corporation stock, purchase the corporation, right, if you are wealthy, or if you want to merge with that corporation. Employees of the corporation may also own stock, either directly or indirectly through a 401k plan or other retirement plan. And at least for those corporations whose stock is traded on a public stock exchange, like the New York Stock Exchange, many financial documents are available to the public on the corporation's website or on some third-party website. Government stakeholders. I've already mentioned the Internal Revenue Service. For corporations, probably the next most important agency is the Securities and Exchange Commission, more commonly referred to as the SEC, the Department of Justice, and a host of other federal and state regulatory agencies. The mission of the SEC is to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. They require large publicly traded corporations to file quarterly and annual reports, known as the 10Q and the 10K, the 10Q being the quarterly, the 10K being the annual return. However, as of the date of this video recording, only publicly traded corporations with 10 million in assets are required to file the 10Q and the 10K. The SEC also regulates new stock offerings, proxy materials sent to shareholders prior to annual meetings, and corporate mergers. To promote a fair market, the SEC prohibits insider trading and tracks unusual stock trades prior to a corporate action that significantly increases or decreases the price of the stock. Insider trading involves not only corporate employees, but actually just about anyone that receives an insider tip that gives them an unfair advantage in buying or selling the corporation's stock. Some years ago, there was a situation where a lawyer who was helping with a merger found out about the merger because he worked at the firm that was handling this merger. He chose to buy a lot of stock right before the merger, knowing it was going to go up, and the SEC sued him for violating SEC rules. Let's talk a little bit about accounting principles. We're not going to go very deep. I just want you to have a really broad understanding of some key accounting principles. Now, first, let's define it. Accounting, very broadly speaking, is the science used to capture financial information. Accountants that work for corporations are required to use something called GAAP, G-A-A-P, not the clothing store. They may go to GAAP, but here we're talking about an accounting principle, or generally accepted accounting principles. GAAP has 4 restraining principles that I want you to know, and these principles are used when the accountants report financial information: objectivity, materiality, consistency, and conservatism. Let's start with objectivity. Objectivity requires that financial statements should be based on objective evidence. For example, suppose that a corporation purchases some land for investment purposes because it believes the price of land is about to go up. That corporation must report the value of the land at the price it paid for the land, not the price which the officers believe it's going to be worth in the near future, right? That would be subjective. So we know what they paid for it. That is objective. Next is materiality, which requires that a corporation report on their financial statements those things which a reasonable investor would find important. So for example, let's say we have a multi-million-dollar corporation and they're being sued by one of their vendors for $20,000. A reasonable investor is not going to be concerned over whether the corporation paid $20,000 to some vendor. That's just not material. It doesn't have to be reported in the financial statements. Now, however, if the SEC sues a corporation claiming that there is a potential $10 million fine that they're going to impose, now that's material, and that must be reported in the financial statements. Third, we have consistency, which requires a corporation to use the same accounting methods from year to year. You could imagine if we could switch accounting methods, that could skew income, right? So if you could all of a sudden shift your expenses to year 1 and then move your revenue into year 2, it creates a disconnect between revenue and expenses. And what the SEC really wants to see, or GAAP, I should say, wants to see, is consistency. And finally, there is the principle of conservatism. And no, we're not talking about politics. Conservatism requires that when there is a choice, that a business report financial information in the least favorable light. For example, under GAAP, it might be possible to report the sale of an asset at $40,000 or at $50,000, depending on the circumstances. So under conservatism, the business must report the sale at $40,000, right? Because that underreports the amount of revenue. Likewise with expenses, right? If you have an expense, if you have a choice between a higher expense or a lower expense, you should pick the higher expense because that provides a worse picture or a more conservative picture of what's going on. So keep in mind, it's not an exact science, which is why we have some of these principles to avoid any abuses by an accountant. Now, let's move on to the financial statements. financial statement provides information about some aspect of a business's activities. Some of the most common are the balance sheet, income statement, and statement of cash flows. The balance sheet provides a corporation's assets, liabilities, and owner's equity on a specific date. The income statement provides a business's income, profit, or loss over a period of time, usually 1 calendar year. And finally, the statement of cash flows reports on the amount of cash that came into the business and the amount that went out from the business over a period of time, again, usually a calendar year. So to encourage people to invest in a corporation, many corporations will place these financial statements, along with additional information, into a visually appealing document called the annual report. Oftentimes they're very high, glossy, nice graphics. Now on the internet probably have videos attached to them. And it's this annual report that is sort of the key document used by many investors. So it is this annual report that is used by many investors in making decisions. It's also the basis for what is required by the SEC 10K report, which captures all the material financial aspects that occurred over a 1-year period. And I've noticed a trend over the last few years. It used to be the case where many corporations would create their own annual report and file a 10K report with the SEC. Notice that the annual report tends, with some corporations, to be disappearing, and that the only annual report really is the 10K. And that deals with the need to not make any changes between the two reports. Corporations don't want to be accused of committing fraud. So if you have one annual report, and the SEC qualifies as an annual report, that's all that some corporations are now using or providing to investors. Now that we've discussed some basic accounting principles and financial statements, the one remaining issue involves the integrity of the underlying documents. I mean, it's nice to have all these financial documents, but how are we sure that they're true? I mean, how can any stakeholder know for sure that a financial statement is not riddled with lies? This is where the CPA comes into play, or the Certified Public Accountant. A corporation hires an independent CPA each year to audit its records and to provide an opinion as to the truthfulness of the financial statements created by the corporation. While it is always possible that a corporation may try to commit fraud, that becomes much harder when a reputable CPA firm is used. For the largest corporations, they tend to use really the same 4 CPA firms, which are often referred to as the Big 4 accounting firms. And they are PricewaterhouseCoopers, number 1, number 2, Deloitte & Touche, 3, KPMG, and 4, Ernst & Young. And with that, we are done with this topic. If you enjoyed this material, hit the like button. Also, to avoid missing any future episodes, hit the subscribe and bell button. For more resources to help you get ahead, including my blog and newsletter, check out learnlawbetter.com. Thanks for watching.